Welcome to TheoTrade. This is Don Kaufman. Here we are on February 8th, 2016. Once again, wild volatility in an intraday setting here in the markets, but we're going to look at a number of things, including, of course, volatility tonight. But again, in the markets today, I think there's a little bit more than maybe meets the eye. This happens to be the S&P futures that we're going to kick it off with tonight. And we're looking all the way down to a 1 day, 1 minute. And the reason I've actually taken it down all the way down to the 1 minute, which is something that I do look at on an intraday basis, is the 1 minute, is to be able to assess volume. So the S&Ps during today's trade, again, are getting hammered. Okay, at one point, we're facing the S&Ps down over 50 points in intraday trade. In fact, you can even see the intraday low here of 1821. Now, one of the areas that to me is a little bit disconcerting in markets, if I zoom in to where the lows are being hit, again, on an intraday level here, you zoom into where the lows are being hit. Sure, you got some big contract size over here. The area that I don't like is in respect to the fact that there's many minutes that are going by, and again, we're looking at a 1 minute basis in the S&Ps where volume is really light. I mean, incredibly light. It's like the liquidity is ultimately disappearing with the markets trading down to 1821. That's not what you want to see if you're looking for traders kind of capitulating. Nevertheless, the markets did in fact catch a bid. That means they rally back up, right? So the markets do rally back up. Now they're still down on the trading session. How big? Well, I guess, looking at the S&Ps, we're in the after hours here in the back down about 5, which means that, first of all, the 1850 level, I don't think holds any weight whatsoever. Okay, so if you're looking at the 1850 level and thinking, wow, they rallied right back up to 1850, that's going to cause support. Yeah, well, after hours, they just crossed through it like it was nothing. And it pretty much is absolutely nothing. But on an intraday basis, again, the S&P still finished down over 25 points. So for that, we go to the SPX. Okay, so we're still down 25 points in the day, but we did cut our losses in half. And some of that was being led none other than by Google. All right, so Google, in terms of the NASDAQ stocks, pulls the market out of what was an utterly hideous day. But Google is coming off the 810 level. Again, this is just 1, 2, 3, 4. In 5 trading sessions, ladies and gentlemen, we've seen Google from 810 all the way deep into the 600 level, and it had a little bit of a bounce day today. However, is this, again, kind of just a rally back up that's going to be sold into? Well, I believe so. And I'm going to show you precisely why I believe so, and then I'm going to give you an update on a couple of positions that I've kind of got going. All right? One of the areas that is most concerning to me, it's not just looking at the volume today in the S&Ps. The volume today in the S&Ps just tells me that trade isn't capitulating. I mean, when you see the S&Ps getting hammered by 50 points on a day, you want to see traders just throwing the towel in. You want to see unprecedented volume. Again, you want to feel like it's the end of the world. And during today's trading session, not only didn't you feel that, you kind of felt like, this is an old gentleman slipping into a warm bath. And that's not the way you want to feel when we're down at 1821 with the SPUs down 50 points, right? Okay, the area that I don't like in markets right now is, once again, in the financials, and I've brought this up so many times. Okay, clearly I see something in the financials I don't like. Forget the fact that they've traded, seriously, forget the fact that they've traded from 25 down to 21. It's neither here nor there. They break the 21 level today in a just fierce trade. This is elevated volume. Okay, no question about it. Okay, the volume inside of the XLF today cracks 100 million shares. It's pretty extreme. Looking at option statistics. Option statistics, though, tell something different. The options volume is relatively light. It's actually showing that the sizzle index, what the sizzle index actually records, it's recording ultimately what today's option volume is versus the previous 5 days. It only traded basically 64%, right, of the option volume versus the previous 5 days trade. And you're like, whoa! But the volume inside the stock was trading about 130% of norm. So I don't like it. I don't like it at all because, again, the option volume is low. You want to see capitulation, you got to see that a little bit heavier. But that's not really what kind of caught me, by surprise. The implied volatility, okay, it's getting up there. Now, let me close up the option statistics and come back over to the right-hand side of the screen because, again, the area I really want to focus on is is prevalent and what is really grabbing my attention. No matter how far out you look inside of the XLF, volatility right now has pretty much gone north of 30%. So what does 30% ultimately mean to you? Oops. Okay. What does 30% ultimately mean to you? And it really amounts to, okay, I'm wild with my pen right now. It really amounts to, so here's the XLF sitting roughly at 20. Kind of means it can move up about 30% or down about 30% within 1 year of time. Now, forget about a year. But look at some of the expected moves now that we're seeing in the XLF. Just 18 days out. $1.22, okay? $1.40 over there. Neither here nor there. What you have to start to grasp is that the financial volatility, okay, is displaying that risk isn't just imminent, that risk is ultimately here to stay. I mean, we're looking, again, a considerable period of time out. What I don't like in this regard is that when you start looking, and some of you are market technicians, starting to look at a chart, okay, you go back like 5+ years and you see the financials, they've had a heck of a run. I mean, we're trading, again, from, this is 2012, all the way from the 14 level up to 25, fade off to 25, we're back down to 20. But here's the area, again, that I want to kind of get you looking at a little bit. We're just going to go add a study. We're going to go down to volatility studies. We're going to change it to implied vol. Just an implied volatility study, right? Okay, neither here nor there. And if you zoom in right now and you look at implied volatility, you're like, wow, it's exploding, right? Like, volatility is really getting up there. It's, 34, 35% right now. And then you zoom out and you start to realize, ruh-roh, volatility can get much worse. Now, you got to go all the way back into 2011 and 2012 to see more serious volatility. The only question I have at this point, are the financials going to feel this volatility? Are we going to hit the 40 to 50% level? Okay. This doesn't mean that I'm fishing for a bottom inside of the XLF right now. Quite the opposite. I want to see if this volatility is going to start to spread, throughout the marketplace, because if you look at the SPX in the exact same light, and the S&Ps right now, and again, I'm going to the SPX and comparing it to the financials, the S&Ps are still faring relatively well. And when you start looking at volatility in the S&Ps in the same light, you're like, well, the volatility was already higher just a few weeks ago. Okay. What I'm trying to display to you is, again, the S&P already kind of felt the fear, but something is going on that's much bigger in the financials, and that's what we want to watch. Okay, because in just the last 24 hours, I'm starting to hear traders talking about credit default swaps. Okay, and that's not a good thing. Credit default swaps in Europe are exploding in volatility. That ultimately means, well, that's kind of what the whole entire financial crisis was about. So I believe that's what has got the financials kind of gripped hold in some of this volatility. Because again, you're not seeing it. If you look at the SPX and you go out through time, the highest volatility sees like 26%. Okay, then 25% it even starts to drop off. So again, the area to watch right now is those financials. Okay, in addition to it, I'd be remiss not to mention the bond market. Okay, the bonds, they're doing nothing less than exploding to the upside. Now, in just recent trade, the last few weeks, we'll just start from the beginning of the year. Okay, so here we are coming into the second week of February. We've gone from 154 level, okay, to 166, which we tagged earlier in the trading session, and we're still at 166 even right now. Now, if the bonds never traded a point higher, the S&Ps could still drop 100 points. Okay, the bonds are already trading like it's Armageddon, and I want to warn you of that. The bonds are trading like it's Armageddon. The financials are displaying that risk is here. If you look at interest rate sensitive stocks, and I hate to do it here, but if you look at interest rate sensitive stocks, it doesn't get uglier than stocks that trade from roughly 37 down to 26, right? It does get uglier. You could actually look at online brokers that are interest rate sensitive, trading from 34, okay? Today dropping all the way to the 23 level. This is just the last couple of weeks, all right? Interest rates exploding are putting pressure forth to the financials. But again, I want to see if the financials in the next couple of weeks, does the volatility just kind of cool out over here? Do bonds start to back off? If not, okay, keep your helmet on. I'm telling you right now, volatility is here to stay. Okay. Again, volatility is here to stay. That doesn't mean a week or 2 weeks. Volatility could subside. You have to start thinking about the next year, 2016 into 2017. All right. We're all discussing interest rates right now. You really think interest rates are going to go up? All right, with a market that's gotten crushed like this, and you're seeing volatility again come back into the financials, the world right now is telling you something. The bonds would not be trading 166, okay, if the world didn't believe we're on either an earnings recession or the verge of a recession. And that's how, again, large this move happens to be inside of the bond markets over there. Okay, a couple of things that I want to mention in terms of trades that I am looking at and starting to enter to. First and foremost, let's go to the XLE. The XLE, I am starting to establish a long position. This is a longer duration long position. That basically means I'm going to sell puts because I literally want to get long stock. This is more of like an IRA type trade, selling cash secured puts. Okay. Again, if you sell a put, people, you better want to get long the stock. Like, I don't want to hear, he sold a put and I had no intention of buying the stock. Okay. You have to want to buy the stock. So again, I've established a handful of positions in here. You can see I sold the 52 puts 18 days out. Okay. I sold the 52 puts 25 days out. Yeah, it's fun. And I sold the what? 50 puts 39 days out. So I'm starting to establish a long position. I'm going to let those mature a little bit. I did this a little over a week ago. What happened? We rallied up and I covered the puts because they basically went out worthless. So I'm going to continue to try to establish a long position. I want to get long right in the neighborhood of about 1,000 shares of the XLE. When I say I want to get long, it means I want to hold the position. Okay, for quite some time. We're talking well over 3 months. So think 90 days, 180 days, a year, if you will. Because I think energy has been just slaughtered. All right. Yeah, that's like a 9-month, but start to look at it in like a 5-year weekly. I don't know. I mean, could I take risks to the downside? Absolutely. But that's okay. Because I'll take risks to the downside and then I'll finance it by selling some premium against another one I'm looking to get long. Okay. I see opportunity here. I think EEM, it's ahead of the curve. Ahead of the curve? What do you mean? It's ahead of the curve to the downside. How about this? Everybody thinks that I'm like the huge bear. Don is a bear. Right now, my deltas are completely and totally flat, and I'm actually getting long. A couple of products that I think have just been slaughtered. EEM is one of them. That's a 5-year. But never fear. Look at the 10-year. You look at like the financial crisis, you're like, those things can go down to 18. I'm like, sold! I'll take it. Okay? I don't think they're going down to 18, but even if they got down to the mid-20s, well, heck, they're already trading in the 20 category here. They're at 29.60. If I just go out and I sell me a couple of them dare puts, I'm selling the 28 puts. If I sell those things for about like 70 cents, I'm getting along at like 27. You have to go back to like the financial crisis to see those kind of levels inside of EEM. I like it. I like it, and I want to get long it because I don't think that we're going head on into a financial crisis. But if I'm wrong, I'll have to sell a lot of premium to cover some of those losses over there. But I'm willing to do it. Last but not least, and again, the EEM is a long duration position. Last but not least, Amazon. I'm in a short duration position in Amazon. It's not going well. Okay? Look at Amazon. Over the last 10 years. It was here, then it was here, and now it's here. Okay? That's ugly. I don't care who you are. That is ugly. So I'm in a short duration position. 32 days I got on the clock. All right, I'm down 22%. Am I going to exit it? Heck no. I have $2.50 at risk. There is no exit for this. The only exit is profitability. On the loss side, hey, what if the stock goes to 300? Don, are you going to exit? No, I'll just let the thing expire worthless. That's the risk you take. This is a binary type trade. We're not going to bail out of it. With that, again, in the next few days in markets, you be careful. You don't try to take a lot of directional positions. You sell some premium. I mean, stuff that's getting hammered, that we're talking about 10-year kind of lows. Sure, if you want to get long a little bit, but nibble. Because I'm telling you right now, there is much more to this market than meets the eye. Keep, all right, your eyes peeled on the financials. It's been a bloodbath in there, and you would expect this product to rally. Financials are not going to rally unless the bonds allow it to. With that, again, I'll be back on tomorrow in, of course, chat, the first 2 hours of the day in the coaching session. On Wednesday, all right, I'll be back in here doing a coaching session also Wednesday night. And we are going to be hitting our first major class February 13th. February 13th, the premium selling extravaganza begins to be archived as well. Thanks a lot, everybody, for joining me. I'm Don Kaufman over here at TheoTrade. Bye-bye.